Hello, my name is Stephen, and welcome to Business Progression. What is the current ratio? The current ratio is current assets over current liabilities. Cool, but what does that actually mean? Well, let's start at the beginning. The current ratio is a liquidity ratio that helps show whether a company can meet its short-term obligations. Put simply, the current ratio shows whether a company has enough money on hand to pay its short-term obligations. Now, when I say money, I'm referring to any asset that will be used, sold, etc. First, it is important to note what I am referring to when I say current. In the business sense, current refers to the time period within a year. So a current asset is an asset that will be used, sold, or basically is available for use within a year. Obviously, cash is available immediately. Inventory, though, must be sold before it can be used to pay an obligation. A current liability is the exact opposite of a current asset. It is something we owe and must pay within a year. Back to the ratio. The current ratio is current assets over current liabilities. The next step is understanding what makes up each of these elements. Current assets are made up of cash and cash equivalents, inventory, accounts receivable, and other stuff such as prepaid expenses, marketable securities, etc. On their annual reports, companies may list these slightly differently, but these are some of the main categories. First, cash and cash equivalents. This obviously refers to cash, literal money. Cash equivalents refers to very accessible investments that are incredibly short-term, less than 3 months. For example, very short-term debt, a money market fund, a certificate of deposit, etc. Basically, it is the money the company is using to generate some interest and can be easily converted back to cash. Inventory refers to goods. It can be shoes, cars, cereal, or even the wheat used to make the cereal. All of these are inventory. Accounts receivable is simply money that the company is owed by its customers for something it has sold. So say our company is a manufacturer and we sell candy. We might sell $100,000 worth of candy to a grocery store. There are often payment terms in place, so when we deliver our candy to the store, they may not actually pay for it for 30, 60, or 90 days. These are our accounts receivable. We have sold the candy, and now the grocery store owes us, but we don't actually have the money. Prepaid expenses refers to an expense we have paid for, but not actually used. Let's say we paid for 6 months' rent, but we are only in the first month. The next 5 months' rent we already paid would be considered a prepaid expense because we have paid for it but not necessarily used it yet. Marketable securities refers to things like stocks, bonds, etc. that are sold to generate cash within 1 year. Alright, we've covered what current assets are, but what are current liabilities? Current liabilities are made up of accounts payable, accruals, debt owed within a year, deferred revenue, and more. Accounts payable is the exact opposite of accounts receivable. Accounts payable is the money our company owes for services or goods we have received but not yet paid for. Accrued expenses refer to money our company owes for an expense that we have not yet paid but have incurred. An example of this would be employee salaries. Most companies pay every 2 weeks or so. The company owes you but hasn't paid you in between the time you receive each paycheck. This would be an accrual. It is money they owe but have not yet paid. Other examples of this would be rent, taxes, utilities, etc. I bet you're thinking this sounds pretty similar to accounts payable. It is. The difference is that for accounts payable we have received an invoice that we need to pay, and with accruals we have not. Debt may be included under different names such as notes payable, but it is literally just money the company has borrowed and needs to repay. Debt can include short-term debt or the portion of long-term debt due within a year. Deferred revenue refers to when a company is paid for something that they haven't provided to the customer yet. For instance, a gift card. You pay the company $50 for a gift card. The company holds this as a liability because they owe you whatever you will purchase with that $50. They haven't actually made money until the gift card is used. But when it is used, the deferred revenue balance would go down, lowering current liabilities, and current assets would go up in cash. Phew, that was a lot. So back to the basics again. The current ratio is current assets over current liabilities. Or as we just learned, very simply, money coming in or being held, perhaps in the form of inventory, over money owed. Time for an example. Let's say a company holds $1,413 in current assets and $1,319 in current liabilities. What would be their current ratio? About 1.07. So how do we interpret this? Essentially, it means for every dollar of current liabilities, we hold $1.07 of assets. In other words, we should be able to meet our short-term payment obligations. Let's try another example. Say a company holds $790 in current assets and $1,200 in liabilities. What would be their current ratio? About 0.66. So how do we interpret this one? For every dollar of current liabilities we hold 66 cents of assets. In other words, it appears that we may not be able to meet our current payment obligations and may be in trouble. But wait, there are a lot of nuances to these numbers. First, we need to remember that the numbers on a balance sheet are a picture in time. They refer to what current assets and liabilities are on an exact date. It does not count the future. So say our company borrowed $1 million to build an awesome backyard. I mean, for $1 million, it better be pretty incredible. But we have borrowed $1 million, so our current liabilities are much higher, but we may not receive payment until we complete the job. Therefore, maybe only the borrowed money was counted in the ratio. But since we hadn't sent in an invoice for payment yet, the associated sale was not counted. Another important note is that selling inventory brings in cash quickly. Along this line is that when we sell inventory, it should be increasing our current assets by more than just the cost of our inventory. For instance, when we sell inventory, we subtract inventory and add the cash from the sale. This cash should include the cost of the inventory as well as the profit margin, leading to an increase in our current ratio. A current ratio that is extremely high or extremely low can be bad. A really high ratio may mean a company is sitting on a lot of cash, inventory, etc. and not using their money efficiently. Too low of a ratio may mean the company is struggling or headed to bankruptcy. That said, there are some industries that operate consistently below a current ratio of 1. Some of these companies are grocery stores, utility companies, etc. That does not necessarily mean they are in distress. There are nuances behind this. As such, it is important to research why a company's specific current ratio is under 1, and very importantly, to compare their current ratio against companies in the same industry. Let's look at a real-world scenario. I have taken data from Target, Walmart, and Kroger's annual reports from 2021 through 2025 and calculated the current ratios for each year. I have plotted these on a line graph. What does this line graph tell you? It looks like each of these companies operate close to a 1 current ratio, but slightly below it. We can see that both Target and Walmart's current ratio is falling, meaning they are consistently holding more current liabilities than current assets. Are they struggling, or is this purposeful? These would be questions I could use further research. Take a look at Kroger, though. They had started with quite a bit lower of a current ratio, and it is now increasing towards the line of 1. Is Kroger doing better recently? Are they coming off of a period of struggle and are now bouncing back? These would be questions that could be looked into further. So rounding all of this back to the beginning, the current ratio is current assets over current liabilities. The money the company holds now or will hold soon over what it owes. A measure of whether a company can meet what it owes in the short term. Or in business speak, the company's liquidity. I hope you've learned something new. Thanks for watching. Hope you have a great day.